Yeah, welcome to this podcast. I have with me Gurmeet Singh. He finished his master's in financial economics from Gokul Institute of Politics and Economics. And then he was working at Indian School of Business for 2 years. And after that, he went on to do his PhD in finance from Institute for Financial Management and Research in Chennai. His research was analyzing the impact of inflation on financial markets. And prior to his post his PhD, he was working at Solitics Partners. It's a data analytics firm based out of Pune in India. They have offices elsewhere in the globe also. Right now, he's working as a consultant in Acuity Knowledge Partners based out of Bangalore. He has to his credit a number of papers, around 7, 8, but his widely cited paper is titled The Short-Term Impact of COVID on Global Stock Market Indices. You are welcome to this podcast, Gurmeet.
Yeah, thank you, Manar.
Yes, so could you tell us what data science toolkit, you know, people, scholars or practitioners use in finance? And if you can, give us 2, 3 examples, to drive home the point, it would be great. Yes.
Yeah, sure. So, like coming to finance, like if you are trying to study any of the financial market, be it equity market, bond market, or currency market, so if you're trying to calculate expected return, that is how much security, be it bond or equity, is going to give in the next 1 year. So you generally try to see the past performance of it, and based on that, you try to make an estimation of what the future might look like. So if you want to calculate the past expected return, so you go and calculate. You go and first of all download the data for the past security prices. So there are actually four price points available in a day. That is the open price, low price, high price, and close price. So people generally try to use the close price as to model expected return. So once you have the closing prices, so you try to compare that price with the market index, be it equity market index or any market index that you generally want to compare your stock against, like how much return you are going to make. So suppose, for example, the conventional CAPM model, that is the capital asset pricing model. So it calculates the return of a security based on the current risk-free rate that you are getting. And on top of that, they will add a premium for the additional risk that you are trying to take by investing in the market.
Okay.
So yeah, so for that you will need the you will need the current risk-free rate that is prevailing in the market,
Okay.
and and then you will need the flow for the beta to calculate how your stock has performed with respect to market. So to calculate beta, you generally tend to regress your
Oh,
stock price movement with the market index. So you will have an idea how
okay.
much sensitive your stock is with respect to the market. And once you have the beta, you can then calculate the market risk premium, that is how much the market generally offers. That is the additional return that you get from the market by
Okay.
investing in the market. So that is your market return minus risk free rate,
Okay.
and you multiply your beta times that return to calculate the expected return. So you can use normal regression models to do that, and
Now we will
that
come to the
is
regression part, but right now, just in terms of let's say valuation of a financial product, and when I say valuation of a financial product, I mean here valuation of a stock which is traded on NSE or Bombay Stock Exchange. So, why is valuation important, and why is it important to arrive at the right valuation of the product? Yes.
Because if you don't know what the actual value of a stock is, you never know if the market price is overvalued or undervalued. So you will need to do a valuation. Based on that, you can then make a call if you want to buy or sell a particular stock. So yeah, valuation is important. You need to know what the stock is worth for, because the market price is always based on demand and supply, and it continuously changes on a daily basis. And
Okay.
there is lots of volatility in the market. So you might not know like if the current price traded is
Okay.
accurate or not. And you also have over and under reaction in the market. That is period of uh, uptrend in the market, period of downtrend in the market. So that might not give you a clear pictures, and people tend to invest stock for long period of time. So
Okay.
since the short term fluctuations are not very important, so they tend to calculate the value of a stock and then try to make a judgmental call on if they want to buy or sell the stock.
So when it comes to valuation, the capital asset pricing model is the most widely used model in finance. Yes.
Capital asset, uh, it it is used in finance, but people have started moving to different model,
Okay.
because capital asset pricing model is just based on one factor, driving stock return, that is the beta.
Okay.
However, there could be particular sectors which are very sensitive to inflation or interest rates. So that is where
So can you give an
pharma,
example?
French, and
Can you give one example of any
yeah,
particular sector which might be very sensitive to changes in the rate of inflation or the interest rate?
yeah. So for interest rate, housing is one of the very important sectors, as you can see, like in the US currently. Once the yields have started to go up, so the housing demand has actually slowed a bit, not slowed a bit, slowed quite a lot, because the mortgage rates there have reached around 7%.
Okay.
So once the interest rate increases, the housing becomes very expensive, because most of the houses that you take are generally funded by loans.
Okay.
People take buy a house with a cash payment, and generally these when people buy house, they are mostly taken on the floating rate, which creates more pain for the consumer. And the other sector is obviously auto sector is also affected, because when we buy car or any bike or anything, if the interest rate is high, that means we are going to pay a particular high interest expense in the future. So auto, housing, in fact, the entire economy is affected by high interest rate. But there are some sectors which will have
So
a good impact. Uh,
can we say that sectors which are impacted more by changes in the rate of inflation or the rate of interest, in these sectors, CAPM makes more of a case when it comes to valuation. The capital asset pricing model is applicable more on in those sectors which are driven by changes in fundamental factors.
uh, Generally, it's uh, you actually need to use your own model to better come up with expected return. uh, Generally, big companies, they have their own built-in model, uh,
Okay.
or to actually calculate the security price. You can also make
Okay.
your own model to calculate the price of a security. It is just that you need to take variables which are actually of interest in calculating the expected return. If you feel that your expected return is like if you're holding a stock, and if
Yes.
you feel that your stock is impacted by oil prices, so you need to take oil prices into consideration when you try to model your expected return.
Okay. Okay. But the evolution of valuation, has gone in the direction where factor models have also been used. Is that correct?
Yes, yes. So, like, there are some factor model, pharma French three factor model, pharma
Yes.
French four factor model, where they try to justify the. So, it's more like when you actually talk about expected return, you want to include variables that are actually justifying that expected return. So Pharma French actually takes in three important factors where they try to justify the expected return. So they say that smaller firms are generally giving higher return compared to higher firms, and
Yes.
then also
Yes.
take into consideration like size of the firm, and
Yes.
so they so those are some of the general models which
Yes.
used to value security, but most importantly, it is the data that you have in hand and how you play with it based on your understanding to get the good approximation of the security return. So, and back test on the data that you have to check if your model is actually working.
Okay. Okay. Can you repeat that again? Because your voice,
Yeah,
yeah.
yeah. So, suppose you have 10 years of data with you of SBI stocks. So,
Yes.
you have built your model on the 5 or 6 years of data. And
Yes.
then once you have built your model on the 5 and 6 years of data, and the next 2 years, you try to check how your model has performed. If your calls on under price security or over price security, what is the accuracy rate of your model? If you
Okay.
see that the accuracy rate is not good, that means your model is not performing well. Or if you're not able to make profit, that means your model is not performing well. So once you have used those 8 years of data, so in actually those 2 years of data that you have actually seen how your model is performing, you can then tweak your model and then run on the next 2 years of data. So once you have actually run your model on the next 2 years of data, you are not supposed to do any more changes to your model, because that will create a bias in your model, because you are every time changing your model based on how the data is performing.
Okay.
So generally it's the data that you build your model on and then you try to validate it. Once you have validated it, there might be some minor changes that you want to make, and then
Okay.
again put it in production that is in use.
Okay. So how do you validate your model? Like, so what
Yeah, so
benchmark do you use to validate your model?
generally you tend to validate your model depending on like what is the performance metrics that you want to see. Like, is your model, because generally data tends to change, and so does your model performance will tend to change. So you want to see if your model, suppose you have built your model on the data from 2005 to 2015.
Okay.
So however, as we can see, post 2020, the market dynamics have changed drastically post COVID.
Okay.
So that model that you were using pre COVID
Yes.
might not be a good
Representation of
uh,
the, okay, the picture that prevails after COVID. Got it. Okay.
yeah. So you might need to see, because one of the most important thing is the interest rate is increasing at an exponential rate in the US and like in last 5 to 6 months,
Okay.
and the bond markets are giving. So suppose for the CAPM model you use RF plus beta times RM minus RF.
Okay.
So the RF they are going is the risk-free rate. So
Okay.
once your risk-free rate is increasing, you tend to expect higher returns from equity market.
Okay.
Yeah, so you need to see where exactly you are standing at the current point in time and how the parameters variables are per- performing or how they are likely to change.
Okay. Yeah, we will,
Because
come
one,
to
Hmm.
more about how CAPM is nothing but a linear regression. But before that, can you tell us a bit about the arbitrage pricing theory? Because that also is based on, valuation. I mean,
Yeah.
it's based on calculating return of a security based on, macroeconomic factors such as inflation or GDP, right?
Yeah, so arbitrage is nothing but the free money that is lying out there. So it could happen that a stock is generally traded at NSE and BSE. Suppose if it is
Yes.
trading at 110 at NSE and it is trading at 111 at BSE, so you will buy at NSE and sell it at BSE and make a 1 rupee profit. So there are multiple securities which generally tend to be traded on two different market. You
Okay.
can buy at one place and then sell it other place. You can also do it for like iPhones. Suppose the iPhone price in Dubai is something different, in India it is something different. You just
Okay.
buy it from Dubai and sell it in India. So it
Okay.
depends what is the transaction cost and everything, and what is your net profit. You can also build your arbitrage model using past data and see like
Yes.
how can you profit from it. So it
Yes.
depends on which market you want to study.
Yes. Because even the representation of arbitrage pricing theory is nothing but a linear regression model. Because here the point is that you take in macroeconomic factors such as inflation and GDP. I mean, it can be other factors also, but these are the
Yes,
factors
yes.
in play. So now coming to the capital asset pricing model. So the capital asset pricing model is based on a number of assumptions. Is that correct? Uh, like
Yes,
the investor is a
all the
rational
models are always based on assumptions.
number of years, but the CAPM model, in spite of a number of developments that have taken place in valuation, continues to remain like widely used even to this day. Is that correct?
I No, I think it is mostly used in MBA schools, but if we actually come to the real world, so people
Yes.
tend to use a good number of models to see like how, because living in an uncertain world, you can never rely on one particular model. So you
Okay.
want to use maybe relative valuation, maybe CAPM valuation, maybe all the particular market model, or and then see like what is the range of a stock price that you
Okay.
expect it to move. So using the as many model, three four, you can, so you can always have a range of your price or your model output that you can expect it to. It's not a particular point, it's always a range that you.
Okay. But one feature of CAPM is its highly simplistic nature because
Yes,
it is a linear regression model, right? It's a simple linear
yes,
regression model, right? So,
yes. Yeah, it is just a one for one, but that is actually not how. Uh, Generally, there is always non-linear relationship between risk and return. So you will always not expect one for one movement between risk and return. It could happen that even like there could be instances where you have taken high risk, but your return has not increased.
Okay. Why could that be the case when you're
Yeah, so risk is a very different concept. Like
okay?
when you actually talk about risk, it is the uncertain output that you are. It is your return should always be considered with the upward volatility, not the downward volatility.
Okay, 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 okay. Yeah, because uh, even in like many literature, there is asymmetry in terms of when there is downward volatility and when
Yes,
there is upward volatility. Is that correct? Uh,
yes.
yes. Okay. Yeah. But you have one final, point, which if you could, throw more light, is that it's the valuation of any product, is not a simple exercise. Is that correct? It's a very complex, tedious exercise, right? Because you have
Yes, you
to,
need to,
yes,
yes, because you need too many assumptions in the model, because when you're trying to value something, you're trying to value the future. And because in an uncertain world, the valuation of future is very difficult. Because in order to value a stock price or a bond market or anything, you have to forecast future cash flows. And future
okay,
cash flows are a function of what your top line and bottom line is. That is how much sales you are making, and out of that sales, how much expenses you are making,
okay,
and after you have deducted the expenses, how much of gross profit you are making, how much of interest you are giving, and all those are very futuristic number. So
okay,
assigning always a particular amount or a dollar amount to those future amount is very difficult. However, once you have the cash flows that are arriving in the future, then you need to discount them back to the
okay,
present value. And yeah, again, discounting them back is very difficult because the interest rate is always changing. So it could
okay,
be happen that today the interest rate is 4%. In next 2 years, 3 years, it becomes 6%. So
okay,
mm, there is quite a good amount of art and science needed with a good understanding of how to use the data at hand
okay,
to arrive at a decent valuation of anything.
okay. Yeah, your valuation is prone to, uh, changes, in the macroeconomy, right? Because you
Yes.
might arrive at one value right.
Macroeconomy or
Yes,
even because it could happen like there are two types of risks that generally happens. One is the systematic risk,
yes,
one is the unsystematic risk. So
yes,
both tend to affect your stock prices. One of the risks you can get away with by diversifying, but there are
yes,
some risks which you can never get away with. So
yes.
depending on that also, I think both of these risks will always make valuation difficult.
Okay, okay, okay. Any other point that you would like to cover, which is important, which you feel we have actually not touched on that?
Uh, I think so you should have a good hands-on experience of on Python and R,
Okay,
and you should know some of the regression tool to calculate the expected return or to build your any of your trading strategy
okay,
or anything you want to do. So
okay.
I think it is you should have a good understanding of the market, and along with that, you should have
Yes,
a good understanding of the data at hand and also the tool at hand to make or to make any good
yes.
judgment on the financial markets.
I think you should know how to get the data from Yahoo Finance. because that is, I think, the most widely used source to derive your data for stock market, right?
Yeah, I think that can be downloaded in just one line of code,
Yeah.
but more than that, it is like what to do with that data.
Yes. Yeah, you should know how to run the linear regression to. I mean, before you run the regression, you should know what a CAPM model is, right? And then if you know what a CAPM
Yes.
model is, you can actually run the regression and then, find out for yourself what the valuation is for that
Yeah,
stock.
and also do some kind of like mean, mode, median, like to know what is the standard deviation, volatility, what is the
Yes,
average
yes, yes, yes,
return of that stock, if there is any missing values or not. It could happen
yes.
that stock is delisted from the market and then again relisted into the market. So there are multiple things. So
Yeah,
you need to like have good
there is.
check on
y-
the data before
Yes.
doing the analysis.
Yeah, good. When it comes to good check on the data, for this podcast, we have just focused on the capital asset pricing model. There is this volatility concept also, which is linked to the stock market behavior, because most of the volatility in the prices is clustered. Either you have upswing, which is condensed, or you have downswing, which is condensed. Correct? But that is where the
Yes,
volatility
yes,
models come into the picture. But we are not going in that direction now. So yeah, thank you, Gurmeet, for giving us
yes.
some details about the valuation when it comes to,
Okay.
in particular, the capital asset pricing model. And
Yeah.
in future, we will also talk about the volatility aspect of the stock market price. Okay.
Yeah,
Yeah.
sure. Thanks, Manar.
Okay. Thank you.
Thank
Okay.
you.
Thank you, Gurmeet.
Bye. Mm,
Thank
mm.
you.
Bye.
Thank
Bye.
you for the discussion. Thank you. Thank you.
Mm, mm. Bye.